Okay, so we'll talk about stock markets and why prices change the way that they do. So, so like for example, if you went down to Macy's to buy a shirt, the shirt might be $20. And you come back 4 hours later, it's still $20. It's just the price they set, and it either sells or it doesn't sell. But the stock market, the price is constantly fluctuating all day long. So I just wanted to go over like an example of what is actually happening. So suppose we had you know the place Jack's down the road here? Mm-hmm. The rib place? Yeah. Okay, so a lot of the college kids go there. So let's just say, to make the example simple, suppose we decided that the restaurant is currently worth $1 million, and let's say there's 10 owners, and each owner owns an equal share. Okay, so that would really mean that there's 10 shares, each one being worth $1 million divided by 10, each one being worth $100,000. And this, let's say it was privately owned, meaning the 10 people are like friends of each other, and you know, it's not, people from outside can't come in and say, oh, I'd like to buy a share. So let's say it's privately owned. Okay, so some questions about this. What if somebody wants to buy or sell a share? What could we do? If it's privately owned, they might have an agreement that says you can't sell your share without permission from the other 9 people. If it's a public company, you have every right to go sell your share because it's open to the public. The question is, what makes the restaurant worth $1 million? How do you say a restaurant's worth $1 million? Anything off the top of your head? There's actually a couple of ways to calculate the value of a business. Anything just off the top of your head that would...
Capital valuation of this, you know? You're asking about like why the restaurant is worth $1 million?
Yeah, like let's say today somebody said the restaurant's worth $1 million. Like where would that number come from?
Or if it's a public company, then it depends on the share price on the market. But if it's a private owned company, there is a valuation that goes based on its business, and its book value, like how much is it really worth?
Okay, but I guess, yeah, the thing I wanted to get at was, like, let's say, for example, suppose you had a certain amount of money, like $100, and you could put it in the bank and be guaranteed to get 5% a year. So you're getting 5% a year, year after year after year, and you'd ask yourself, well, what would something that can generate $5 a year forever, what would that be worth today? And that would be worth $100 if the interest rate is currently $5. So if I said to you, I have this thing that keeps spitting out $5 a year, what is this thing worth? You could calculate based on what the interest rate, what the thing is worth, and maybe $100 would spit out $5 a year. So if you had a restaurant that keeps generating every year $50,000 in profit, like after you pay for the food, after you pay all the employees, the electric bill, all that stuff, it keeps generating $50,000 and the current interest rate is 5%, you might say, oh, this thing's worth about $1 million. Then the 10 people can say, oh, well, if the whole thing's worth $1 million and I own 1/10, that means my piece is worth about $100,000. So if I go to sell my piece, that's, you know, there's kind of mechanisms that you can value what this thing is worth, and then you own a share of that. So now the question is, can events happen that cause the value to go up or down? After let's say you've bought a share for $100,000. Could something happen that makes this $1 million go like way up or way down? Like a piece of news could happen. So, like
when the business goes down for whatever reason.
Yeah, like let's say another place opens up across the street. Or, you know, now you're competing with somebody else. Now you're, oh no, I shouldn't have bought this. Now the value of this would start going down. In the public's, you know, in the public's mind, it would start going down. Or like if the college closed, then nobody's going to go down. That's the college bar, right? But if the college enrollment went up 50%, this would be great. Then this would mean a lot more profit. So this value will be like constantly changing. And then if you own 1/10 of it, well, then the 1/10 will change with it. So I just wanted to kind of get the idea. I wanted to like make it a small business with, say, 10 owners. And then talk about the same thing with a publicly traded company. So a publicly traded company is where the share owners, the individual owners, usually it's more than 10, it goes into, you know, millions of shares or billions of shares. And then the question is, analysts will try to figure out what is the value of the overall company, considering what it's planning to sell or what the profits are going to be for the coming years. analysts will try to figure out what the value of the company is. And then whatever the value of the company is divided by the number of shares, that's how much one share should approximately be worth. And big companies like IBM and Microsoft, they have news that makes their value go up or down. So let's say Apple came out with a new operating system that's going to compete with Microsoft. That could cause Microsoft's overall value to drop, and therefore the share price would drop. So the demand from the market on those shares would drop, and therefore if you went to sell your share, you might have to give it for a lower price. So it's not a whole lot of difference between a publicly traded company and then a place like the Rib Place down the block. So publicly traded companies generally trade on an exchange. So there's a place where the company goes to register, and then the public can come and say, I'd like to buy some shares, I'd like to sell some shares. So it's a picture of the New York Stock Exchange in New York City, a pretty popular one. And then features of a market are, you know, the best bid, best offer battle, and I'll get into that in a second. The stocks are sold at an auction, so it's whoever the highest bidder is will sell them. And we'll talk about what market orders are and limit orders. And then I just want to get across the idea that stock prices will be constantly changing. It's not like a sweater at Macy's that just kind of sits there for $20 for 5 days, then it goes on sale for $10, and then it goes back up to $20. It's basically the demand is going to cause the price to constantly change. Okay, so when you say there's two main types of orders when you go to buy or sell stock, and one of them is a market order. So a market order is basically, I'm not going to read this to you, but you can read it if you want. A market order is basically when you say, I want to buy or sell this stock, and I'll take whatever the current price is. I'm not going to set a price. I'm not going to say, well, I'll only sell it for if I get a price of 102 per share. You just say whatever the buyers are willing to buy it at, I'll sell it to them. So does that make sense? That you're just saying, I'll get whatever price I can currently get from the market. And then the other type of, and I'll go over an example where this is used. The other type of order you could put in is a limit order. That's where you specify a price. So for example, let's say IBM's selling at $100 a share, and you own some shares and you would like to sell them. So you don't want to sell them for 100. You might say, well, if somebody's interested in paying 102, then I'll sell. If not, I'll keep it. And a buyer might come in and put in a limit, a buy order for with a limit, and say, well, I'll buy it, but I'm only going to pay 98. Now, you'll sell it only if you can get 102, and the other person will sell it only if they can get 98, and there's no deal at that point. Unless somebody else comes in with a market order and says, I'll pay whatever the seller wants, then you'll have a deal. So it's the combination of these two types of orders is what's going to create the market. So at an individual firm, if you get a job at an individual company, they have trading floors where they're gathering up from all their clients all the buy and sell orders and the limit and the market orders, and they're putting them together in a queue, and I'll go over the queue in a little while. They're putting them all together, and then they send their order stream down to the trading floor at either, you know, wherever the stock is traded, like if it's the New York Stock Exchange or the NASDAQ exchange, wherever the exchange is, they'll send the orders down there, and then other companies buying and selling the same stock will create a market. So eventually the order gets put in and sent down to, here's a picture of the New York Stock Exchange trading floor. And then there are people who are called specialists, and that's the person you'd have to go to. For example, if you want to buy or sell IBM stock, you'd have to run over to the guy on the floor who buys or sells that stock and say, I want to buy this many shares, and I have a certain number of market orders and a certain number of limit orders, and then he would have to find somebody who would match up to the other side and sell the price, make the trade go through. So here's an example of, let's say in this market, you've seen these kind of like these ribbons going across the bottom of your TV screen. So let's say this ribbon is saying that IBM is currently selling for $100 a share, and Lucent is selling for $275 a share. So I picked Lucent because they're right nearby. And now let's say this is the selling queue. So just focus on this part of the picture. So this is like a before and this is an after. So suppose we have seller, I'm going to call this person market order 1, M1. And they say, I would like to sell 200 shares of IBM at the market price, whatever it is. So they're basically saying, just, I want to sell it. I don't want to argue about the price. I'll sell it whatever the price is. Then behind that person is market order number 2, who wants to sell 200 shares of IBM, also at whatever the market price is. And then behind that person is, I'll call this limit order number 1. This is somebody who says, I have 400 shares to sell, but I will only sell it if I get a price of $100.25. Otherwise, I'm not interested. So even if this order, let's say this person came first and this person came second, if this order comes in either from, gets sent down to the trading floor from a firm that may be up at their trading desk, some customer put this order in, this would be a market order, so this would get pushed in front of the limit order in the queue. So there's a queue where the markets are going to meet, and wherever they meet, that's where a deal goes through. So market orders always go to the front of the queue. They always jump ahead of limit orders. So when you're putting in a limit order, it's good you're demanding a certain price, but the problem is the market orders will keep jumping ahead of you, and it might be a while before you get your price. So, market order 1 is 200 shares of IBM at the current market price. Market order 2 is another 200 shares. And the reason this one is behind this one is it's first come, first served for market orders. Okay, now on the buying side, these are people who want to buy. Let's say a buyer came in and says, I want to buy, I don't care what the price is, I just want to buy some right now. So I want to buy 100 shares right now, I'll take whatever the market price is. And then another person, buyer market 2, wants 200 shares also at the market. So why is this person behind this person? Because they came in after. Let's first come, first serve. And then let's say there's a buyer limit order. This is somebody who wants to buy, but they want to get a good price. So they're saying, I'm only going to buy it if it's $99.75. Then I'll buy it. Otherwise, I'm not going to buy it. Okay, so the last time a trade went through was at $100. So if this is the way the queues are at this instant in time, what will happen? Well, the person who wants to sell 100 shares at market will line up at the front of the buying queue with the person at the front of the selling queue, and this seller is willing to sell 200 shares also at market. So what will happen? These two, this person will buy 100 shares from this person. At what price? Whatever the market was. Whatever is the last thing that went through. So now what happens is, this one will be gone. I mean, I could have drawn these pictures in stages, like each step along the way. Buyer 1 will be satisfied and then get out of the picture. And we'll have to fill out all the paperwork to transfer all the shares from this person to this person. And that could, that's a whole nother story, what happens after a trade is made. But anyway, what happened was, buyer 1, market 1, got 100 shares at $100 from this person. Now this person still has another 100 shares that they're just looking to sell at whatever the market price is. So who's next? Assuming no more orders came in since that one executed, this person wants to sell, wants to buy 200 shares at whatever the market price is. And this one still would now have 100 more to go. So the first 100 from here would match up with 100 from here. The price is still at 100, so that would go through at $100. And now this person is gone. They're now out of the system. They've made their sale. So they got every share they put up for sale, ended up selling at exactly 100. And now they're gone. So this person's gone, and this person still has 100 more shares that they want at market, meaning they'll take whatever price is out there, 100 shares. Okay. So this one still has another 100 shares to buy. This person's gone. Now the next person shows up who is willing to sell 200 at whatever the market price is. And this person needs 100 more. So what happens? This 100 matches up with the first 100 of this person, That goes through at $100 sale, so they mark that. And then what happens? This person still has another 100 they would like to sell at whatever price they can get, whatever the best price they can get. And the next person in the queue is a limit order, 100 shares at $99.75. So this person's sale will be 100 shares went through at $100, and the second 100 went through at $99.75 each. And they're going to get a statement that looks a little strange. Their statement will say, you put in a market order, we sold for 200 shares, meaning you'll take whatever price we can get you. And we sold 100 shares at $100 and another 100 at $99.75 each. So you're like, all right, well, you said you'll take whatever price they get, so that's what ends up happening. These shares are now gone. This whole side of the queue is now gone, and then, you know, whoever comes up after this in the queue starts moving up to the top. And these should be gone, and now these should be gone. And the very last deal that went through was this 100 plus the last 100 of these went through at $99.75. And now the new price is $99.75. So as soon as these deals go through, the queue will be, in this case, well, you couldn't see it, but like right after this one was a limit order, limit number 2 for $99.50, and then limit number 3 at market. That's not right. These should be lower numbers. Sorry about that. And then limit number 1 is this guy. This guy now moved to the front of the queue. And then there might be other limit orders behind him at higher prices. So now the market is sitting like this, and the next 2 up to the queue are now limit orders that the prices don't match. Right now, the seller, the best price a seller is willing to give is $100.25, and the best buyer is looking to pay $99.50 and no more, which means right now no deal is going through. So the price is currently going by whatever the last one that went through is, and right now the market is frozen temporarily. What would cause a sale to go through at this point? If the queues were like this, where it's pure limit orders, no market orders, and the prices have a gap between them, that means right now no deal's going through. So what would it take for a deal to go through?
If the price changes for an external reason,
Well, yeah, but what type of, even if some news came out, let's say some news came out about IBM, like they just sold a bunch of, you know, new products, or a competitor, one of their competitors went out of business, which means they should make more money. What would then happen? If the queues stayed like this, still no deals will go through. But what will happen is, once maybe some good news came out, some people say, oh, I want to buy IBM, I'll take it at market price. So as soon as a market order comes in, buy or sell, it will get matched up against the limit order. And then the price will move to whatever that price is. So for example, if the queues were exactly like this, and a market sell order came in, it would hook up with the buy order, and then the price would go to $99.50, and that deal would go through. And if a market buy order came in, someone said, I'll buy it whatever price I can get, I'm not going to fight about the price, I'll just take it. The best seller is $125, and then the price would go up to $100.25. So it's just basically, what's happening all day long is the queues are filled with market orders, market orders and limit orders. And as long as there's a market order on either side, it's going to get matched up against the other side, and a deal will go through. And it'll keep flushing out the market orders until you have just limit orders, and then the price freezes at that point for a little while. And then more markets come in, deals get struck, deals get executed, and then it goes back to limits on both sides, and it sits there for a while. So the stock price is changing, but it stays at a certain price. Yeah, I'll get to that in a second. So, and then just one last thing. This is a definition that comes up. It's not really going to come up much in our course, but what an initial public offering is is basically when a company goes from being private to being public, what's happening with the queue, they're going to create a queue on a certain date. The selling queue is going to be, the company itself prints up a bunch of stock and says, I'm selling them all on the opening day. They have to build up this really huge market queue of all these people who agree to buy the stock at whatever the seller sets it at. And you can't really do that until you build up the queue to the point where you're going to sell all the company stock on the opening day. So then, like an investment bank is a company that goes around, investment bank is basically gathering up all the buyers, getting them all to agree in advance to a certain price. One price, you know, like Facebook IPO just recently, it was $38 or something a share. So they got like all these people on the, all the people on the buying side of the queue, all lined up on the opening day, and all those deals go through instantly when it first opens, and then it becomes a publicly traded company. So I just wanted to throw that definition out, an IPO. But the other thing I wanted to just go over, and this is important for the type of mathematics we're going to be doing in this course, is just to understand that the stock price function over time is not smooth. So in other words, we could have, like, let's say this was at 100. The stock price from this, so this is time going this way, and this is the price. So the stock price might sit at this, you know, the last trade to go through is at this level, and then just time's ticking. Nothing's changing, and then boom, at that point, market orders come in. So it looks like a market order on the buy side came in, so the seller got the price he or she wanted, and then the price jumped up. So some trades got executed, then it kind of froze for a certain period of time, and then another buy order at market came in. And then just for a little while, and then all of a sudden, it was at the point where it's just limit orders until a sell order at market came in, and the limit order was, you know, lower than even the last time, and it drops down to this price. Now during this time, this is all just limit orders are in the queue. Limit orders all the way, and then all of a sudden the market order comes in and it drops. Then the market clears, we have just limit orders, we go to a certain point, then another limit order to sell, right? What makes the price go down? When a market order to sell, I'll sell at any price. The buyer gets what they want, which is always lower. Yeah, so a market order to sell came in, dropped down to here, then a market order to buy came in, brought it back up to here. So the curve for a stock price over time would look like a series of lines like this. So then, so one of the issues with stock markets, this is kind of just a side comment, but you might be wondering, why do stock markets, now that you know, computers are pretty sophisticated, why does the stock exchange have a bunch of people running around yelling at each other all the time, right? So like somebody says, oh, I want to buy IBM at, I want to buy 100 shares at market. So you run over to the guy who's responsible for buying and selling IBM on the trading floor and say, I want 100 at market price. And then he yells over at somebody, hey, who wants to sell? And then, you know, and then the person will yell, well, I'll sell it, but only at 101. And they'll say, do you agree with that? Like, you know, there's people yelling at each other. Like, why can't you just put it in a computer system? Say, this is what I want, and have the computer system figure out the cues. Do you ever wonder, you know, with computers, why do they still do that? So there is one, like, can you think of one danger to letting it all be computer automated? Like, let's say IBM is currently selling, let's say we got to this point where we now have at the top of the queue a limit order at $99.50, so a limit buy, and a seller, the best seller, is saying I'll sell it $125. So right now nobody's buying, nobody's selling, because the sellers are demanding too much and the buyers are giving too little, so right now no deals are going through. What if if this was all computer automated, what if all these people, at any point when you put in a limit order, you can cancel it at any time. You could just type in and say, all right, take my order away. I give up, I don't want to sell it anymore. So you decide to take, let's say the entire queue, this is kind of like the lottery being hit. The entire queue, everybody cancels their order. And now there's nobody buying, absolutely nobody. And then somebody puts in an order, right? Let's just say hypothetically, the buying queue is gone. Nobody has a buy order. So you decide, just for a laugh, you'll put in a buy order at $1. Let's see if you get a sell. So you put in a limit order at $1, and then all of a sudden somebody says, I want to sell. I don't care, I'll just take whatever the market will give. And they put in a market order, and the closest thing, just for an instant of time, just for like a 1 second period, your order is the only one there for $1. You'll be able to buy 100 shares at $1 for the guy who said, I want to sell 100 shares at whatever the price, whatever the market gives me. Whatever the market gives you is the best limit order. That's the price you're willing to take. That's, by definition, that's what a market order is. I will take the best limit order out there. I'll agree to that price. And then all of a sudden, there's one sale going through for $1. So like it's going like 100, then 99.75, then 125, and then all of a sudden $1. Someone got lucky, right, and put an order in. So if it was computer automated and you didn't put software in that said something like, well, if the price drops like 50%, don't let it go through. But sometimes that's the way it is. Maybe stocks do drop 50%. So a lot of times a human being sitting there would go, whoa, the only thing I got in the queue is $1. Hold on, there's something wrong here. Let me find people who are interested. And they could actually run around and say, hey, I got a guy willing to sell this stock. Is anybody willing to, yeah, I have someone willing to sell it at market value. Does anybody want to buy it? It's a good deal. And someone will say, all right, I'll take it for 95 or something. You don't let the deal go through at $1. So it's kind of an argument. We need some kind of a safety mechanism of just letting computers run and execute these trades. Obviously, this wouldn't happen in a very popular stock like IBM. The queues are enormous. But some not so popular stock, not too common, or even something like, we'll talk about later in the course, options on stock. There are options on stock, but not the whole world is buying options on the stock. They're mostly focused on the stock, and then options that like expire a year from now don't trade very often. So there's not a lot of orders coming in. So it's a little dangerous to let computers just let the trades go through. But anyway, so the most important thing I just wanted to stress is, first of all, why are stock prices constantly changing all day long? And it's just these markets, the limit orders and the market orders coming in and matching up. And then the other thing is that the gap of time, it's not like a trade must go through every second or every 10 seconds. The gap of time it stays fixed at a certain price is not controlled by us. It's not a fixed interval. So they're random size intervals. How long the price stays at one value is random. And the function is not smooth, like it doesn't slowly curve up and then slowly curve up and then slowly curve down. It's a step function. It jumps up and down in steps. So if we start doing mathematics like integrating on this, normal Riemann sum integration doesn't work right on this. So it's just important to know the behavior of stock prices. And what's the other thing I wanted to talk about? We want to understand why the price is changing the way it is. But the other thing is, we're going to make an assumption that in our models, we're going to be doing things like buying stock. We're going to be using tricks like this. Let's say we were to take some of our own money and then borrow some money from a bank, put that money together, buy some stock, hang on to it for a certain amount of time, and then sell it at a certain instant in time. Where would we be compared to if we bought a stock option? We're going to be doing like questions like that. So we're assuming that we can buy and sell stock at any instant. So we're gonna be making an assumption that according to our model, if we decide to sell a stock at 2:30 on a Wednesday afternoon, somebody will buy it. We're not gonna sit there for 5 minutes waiting for a buyer to show up. We're gonna be able to buy and sell stock at any instant. So the assumption is the stocks we'll be using have a very, very big market on the buying side and the selling side. There's plenty of buyers and plenty of sellers, and we'll always be able to buy it the second we wanna buy it, and we'll always be able to sell it the second we wanna sell it. And we can always just put in market orders and they'll be taken right away. So those are two important assumptions we're gonna be using. So some of the mathematics we use won't work on stocks that trade very, very infrequently. So that's just a little background. Just kind of know what, you know, this is what's going on, so when you're reading the textbook by Hull, it assumes, what do they call this, highly liquid stocks? Highly liquid market? Just that you could always get a buy or sell order anytime you want. And there'll never be any crazy prices like it drops down to $1 for a second and drops back up. There's none of that going on. But it's kind of good to just know that that stuff is possible, and then we're going to assume it could never happen to us. So, okay.